Okay, you're live.
Hi, everybody. I'm Chuck Roydhouse, President of the Chimney Safety Institute of America. Thank you for joining us once again on this Thursday afternoon panel. It's graciously hosted by John Meredith of Saver Systems. And the intent is give you guys some really good content of what would be good for your business and help you move forward with whatever it is you're struggling with. This is a program provided by the National Chimney Sweep Guild in conjunction with the Chimney Safety Institute of America. We value you as a client, and we value you as a member of the Guild. So with that, I will turn it over to our host, John Meredith. Thank you.
Thank you, Chuck. I'm really excited today to have one of the guests who really changed my business DNA years ago, and he's been around our industry for a long time. But everybody's, there's new people coming in all the time. Many of you have heard of, or maybe even heard Tom, but his message is timeless. And so I want to introduce Tom Grandy, who is a founder of Grandy and Associates. And I'll let him share a little bit about his background. But before I do, I want to tell you, just to kind of mention next July the 9th, we kind of wanted to do something that was tailored more toward guys who wanted to scale their business. So if you're a one truck operation and you want to grow to a multiple truck operation, we're going to have two guests on that have, one guest that has grown to a 3-truck operation has found kind of a sweet spot there. And then we're going to have another gentleman many of you know is Mark Stoner. He's grown his business to a 30-truck operation. And both of these guys have kind of found the sweet spot that makes their business, where they found a profitable little niche in the amount of trucks, and then kind of what you need to know as you scale your business. So I'm really excited about July the 9th, so be sure to register for that. You'll see something about that coming across pretty soon. And the title of that is Scale to Your Sweet Spot, What You Should Know As You Grow. And the cool thing about that webinar is going to be you're going to be able to learn from all the mistakes that our two panelists, Chuck Roydhouse and Mark Stoner, have made over the years, and you want to make them all yourself. So that's a pretty good thing. So we appreciate you being with us today. So Tom, we'll just jump right in here. Just tell me a little bit about your background. I can tell you that before you do, I just want to mention that, Tom, I want to thank you for when I had my sweep operation in the 80s. I heard I went to one of your, maybe it was at the Guild, maybe one of the Guild NCSG conventions. I heard your presentation, and then I think I engaged you, bought some of your materials, and it really changed my business. And it turned me from a struggling business to a more profitable business. I think anybody in business today is struggling, but it certainly changed my business DNA. So I just want to thank you for that. Appreciate you so much.
You're welcome.
So Tom, tell us a little bit about your background and what you do, how you do it, and how you kind of got into this business.
Okay. Well, I'm actually an industrial engineer by training. Graduated from Virginia Tech way back in 1970, worked in industry for a few years and got involved in small business thereafter. Spent about 3 years as a general manager of a service company, so I have a pretty good sense of where most owners are coming from on a daily basis. Prior to that job, I was always told that if you owned your own small business, worked 3 days a week, made lots of money. Mine didn't work that way. It was a long, hard, tough, frustrating job with a lot of satisfaction in the middle of it. It's not an easy job. From there, I went to work for the Dial One Franchise Network, which was a national franchise of the service and trades industry. I worked as the regional director of company development. And then in 1987, we started a company called Grandy and Associates. We've been providing business training to the trades industry since 1987. Actually started working with the Guild about 89. So we've got a long history with the National Chimney Sweep Guild in terms of presentations. So that's kind of the background. We've been doing it for 33 years now.
I appreciate that. We'll get into this a little bit later, but go ahead and share with us your presentation today, and we'll talk a little bit more about kind of why that matters as we move along through this through your talk today.
Okay. The topic obviously today is The Price is Right. We're going to talk about how to set proper hourly rates within your company. But before we do that, I want to spend just a couple of minutes talking about how most companies got started. This may not be your particular story, but I guarantee you it's a story of probably at least 90% of the owners in the entire trades industry. It's not just the sweeps and it's HVAC, plumbing, electrical, pool and spa, it's everybody. because probably a good 90% of the owners today in the trades industry used to be a technician working for somebody else. We worked for that somebody else for a year, 2 years, 5, 10, 15 years. All of a sudden one day we're out there in the field and this little light bulb goes off. The little light bulb basically says this. So you know what? They're paying me X number of dollars per hour and they're charging the customer this humongous amount of money up here. If I wanted a business for myself, I could charge that high rate and I'd be rich. So I think about it. A few weeks, few months, maybe several years. All of a sudden one day I make the break and I start my own company. Typically I start out of my house or garage, a very small facility, maybe by myself, possibly with one other person. And what's my first major challenge? Gee, how much do I charge? Well, that's not a real problem. I just call over town, find out what else is charging, and that's what I charge, or probably a little bit less. And lo and behold, I'm in business. And the irony of the industry is the first 1, 2, 3, maybe as many as 4 years goes along relatively well. And the reason, if it takes a couple steps back and look at things, the reason it goes well is because, hey, I'm working out of my house or garage. My overhead's really, really small. But I'm kind of charging real close to what the rest of the industry is charging. So my profit margin is pretty good. So the first year, 2, 3, maybe 4 goes along relatively well. And then usually about the 3, 4, 5 year mark, the strange phenomena begins to take place. The strange phenomena is now we're doing more and more and more work, and we're making less and less and less money. I find myself scratching my head saying, what in the world is going on? What in the world is going on? In our industry, it takes anywhere from 1 to 3, maybe 4 years to even understand we got a basic problem in our industry, in our particular company for that matter. And during that 1 to 4 years, it's usually 3 distinct steps. I call them 3 steps of going out of business. And I want to share those with you briefly, just in case you happen to be in one of those and started the slide and don't even know it yet. Because the first thing is cash flow is tight, profits are down. So what's my first natural solution? I'll just do more work. I'm working 5 days a week at 8 to 4 in the afternoon. I'll work 10 hours a day instead of 8 hours. Or maybe I'll start working on Saturday, or maybe I'll work 7 days a week. What's that do? That puts more cash flow back into the company. I can pay my salary, I can pay my bills, everything seems okay. Another 6, 12, maybe 18 months. Then I'm right back where I was before. Well, gee, the company's growing. We've added another tech or 2. We're getting a good reputation in town. And know if I could just hang on a little bit longer, just a little longer, everything would be lovely on the other side. So step 2 is this. Well, gee, those first few years when I was making some money, I had put some of that money aside into a savings account. I'll put that money back into the company. That'll buy me a little bit more time. I'll get over that hump and everything will be lovely on the other side. So that's what I do. I take my savings, I put it back into the company. Again, now I can pay my salary, I can pay my bills, everything seems okay. For another 6, 12, maybe 18 months. And I'm right back in the same situation a third time. Well, now we've moved into a nice building. We got a great reputation in town. The company's continuing to grow. We're just not making much money, but I know if I could just hang on a little bit longer, just a little longer, everything would be lovely on the other side. So my third step, and often my final step, is this. And that's when I extend my line of credit to my suppliers as much as I can extend it. That's when I go to the bank and get that second or maybe a third mortgage on my house, sell any unnecessary equipment and or stock. In other words, try to generate as much cash as I can generate to buy me a little more time so I can get over that hump so everything's lovely on the other side. And unfortunately, step 3 is just like 1 and 2. It buys me a little time. It doesn't solve the problem. Doesn't solve the problem. At that point, we sit back and say, hey, you know what? There must be something going on that I don't understand and I haven't changed yet. Well, it could be lots of things, but about 80 to 90% of the time, it all boils down to improper labor pricing, not knowing how much we have to charge, cover our cost to make a reasonable profit. And that's what we're going to do today. We're going to go through a sample company. It could be any department within your company. We're going to pick on the sweeping department, but it could be any company out there, any department within your company. And we're going to model a sample company and take you through the steps of how to set proper hourly rates in your company. So let me just kind of describe the company we're going to have here. We're going to start out with our sweeping department. It has 3 vehicles. We've got a 2015 Chevy van. It's going to last me 3 more years and cost me $24,000 to replace 3 years from today. We got a 2016 pickup truck. It's going to last me 4 more years and cost me $28,000 to replace. And then we got a 2018 Ford van. It's going to last me 6 more years and cost me $30,000 to replace. And I'm going to have 3 technicians in my sweeping department. I'm going to have one that I'm paying $21.50 an hour. The second one we're going to pay $18.50, and the third one $17.50. My average non-billable time, that is the time I'm paying for, that I can't charge the customer for, is 45%, roughly half their time. And you may not believe that, but we're going to get into that in a little more detail here shortly. My sample company has a 3% state unemployment rate, and we're going to sell $50,000 worth of parts with an average 100% markup on it. And that's my sample company. In terms of the overhead costs for my just for the sweeping department, I'm going to have a dispatcher. I'm going to pay $28,500. I'm going to spend $15,000 on advertising, $5,300 on workman's comp, health insurance, bad debt. You can see the items on there. Variable overhead of small business tools, uniforms, gasoline. So if I add up those fixed and variable overhead costs right there, that's $230,000, excuse me, that's a significant amount of money. Now we've also got the general overhead for the rest of the company because we're doing things other than sweeping. So the rest of the company has a total overhead cost, fixed overhead of $230,000. Okay? Now, because our sweeping department does 20% of our sales, we're going to take 20% of that general overhead and we're going to apply that to the sweeping department as well. So that's $46,000. Now, that's not the way you spread overhead. There's 6 or 7 different ways you should do it properly. But we're just going to assume today, to keep it simple, 20% of the general overhead is going to go into our sweeping department. Okay? So what we find out is our fixed and variable overhead plus 20% of our general overhead, that totals $147,000 in terms of what it costs me to run my company. Now that's the beginning, that's not all of it, but that's the basics. Okay? So the question is, how much do I need to charge for my little 3-man sweeping department in order to generate a 15% net profit in the company? That's our objective. That's what we're going to walk through today. There's 10 worksheets already filled in. So we're going to walk through them one by one. First thing we're going to talk about is our equipment replacement cost. Now, everything we do today is going to be done from a cash flow perspective as opposed to accounting. Big differences between the two. Accounting tends to work with paper dollars, where cash flow deals with the real dollars that flow in and the real dollars that flow out. One of the big differences between cash flow and accounting is this one right here. It's equipment replacement cost versus depreciation. Depreciation is an accounting term. It says you can write off that piece of equipment generally over 5 years, 20% a year. But it's always dealing with what you paid for that piece of equipment 2, 3, 4, 5 years ago. When we talk about equipment replacement cost, we're talking about what it's going to cost us in the future and then build that future cost into today's pricing. So when we talk about equipment replacement cost, everybody listening to me has got at least one piece of equipment. I don't care if you're a one-man operation, you've got some kind of vehicle that's going to get you from point A to point B. Someday, each and every piece of equipment you got is going to wear out. It's going to need to be replaced. Now, the question is, how are you going to pay for it? It could be a loan. Okay. Now, if it's a loan, that's fine. You can build it in. But the question is, we really want to build it into our pricing so when we're ready to replace that piece of equipment, we've got the dollars available to do it. Okay. If you want to know whether you've got equipment replacement costs built into your pricing or not, just ask yourself one simple question. And that simple question is, last time I needed to buy a piece of equipment, did I pay cash for it or did I get a loan? If I paid cash for it, chances are I've got those dollars built into my pricing, even if I may not understand it, but at least they're in there. If I had to get a loan, that's the first red flag telling me I don't have enough money built into my current pricing to take care of the replacement of my equipment when it's time to do that. The cost of replacing your equipment is a very real cost of doing business, and it's a very large cost of doing business. Typically, equipment replacement cost is your second highest cost of doing business in your entire company. It's more than insurance, more than marketing. It's more than anything else except for the cost of labor in the middle of the process. And how do we calculate it? It's really pretty simple. Let's say I bought a used vehicle back in 2018. It cost me $22,000. It's going to last me 3 more years. Well, 3 years from today, that same vehicle, I'm estimating, is probably going to cost me $27,000 to replace it rather than $22,000. So if it's going to last me 3 more years, I take my $27,000 divided by my 3 years. That means I need to build $9,000 a year into my budget, $9,000 a year into my pricing, so that when I'm ready to replace that piece of equipment, I've got the dollars available to do it. Now, some of you are larger companies and you're looking at that $9,000 and my goodness, Tom, I got 1, 2, 3, 4, 5. Whoa, big number. And it is. It's a huge number. Generally, it's your second highest cost of doing business in your entire company. Now, before we look at the worksheet, let's talk about 4 different situations that you may or may not be in. Some of you may be leasing a piece of equipment. If you're leasing a piece of equipment, don't put it on this list. Why? Because you're paying that lease every month. Hopefully it's in your overhead and therefore it's in your pricing. The exception to that is if you got some big buyout dollars or something like that at the end of the lease from wear and tear. Second situation, you may have a piece of equipment that you're paying on a loan right now. We're going to turn right around. We're going to put it on our equipment replacement list. Now, if you think about that for a couple of minutes, you're going to think, gee, Tom, isn't the cost in there twice? In a sense, it is. We're paying off our existing loan while at the same time we're putting money back for its replacement later on. The objective here is to get ourselves out of debt. There's going to be another 2008, 2009 sometime in the future. When that happens, it's the company that's got the lowest overhead that survives. So we're going to pay off our existing loan, plus we're going to be putting money back for our equipment replacement. Now, the beauty of that is I've got a $500 loan payment, and that's $6,000 a year, and I pay off that loan. What happens to that $6,000 as soon as that loan's paid off? Well, gee, it goes straight to the bottom line in terms of profit. Every time I pay off another loan, my pricing stays the same, but my profitability increases because I put money back for the replacement of that equipment at the same time. Now, some of you may be in a situation where you've got 1 or more pieces of equipment you need to replace immediately. Immediately meaning sometime within the next 12 months or so. Well, if I had several vehicles and I need to replace them all the same year, and I built all that cost into the same year, what would happen to my hourly rate? It would be unusually high. So anything we're going to replace within 12 months, we're automatically going to spread that over 3 years just to come back to a realistic hourly rate. We only want to put items, number 4, we only want to put items of significant value on there, generally over $1,000. Primarily what we're talking about is mobile equipment, but it could be trucks, vans, computers, anything over $1,000 that you'd normally put on an equipment replacement list. And then you do have one option in the middle of it, that option being additional pieces of equipment you may need in the future. You can do this or not. Let's say I've got 3 sweeps right now, and 3 years from now, I expect to have a 4th one. So guess what? When I hire that 4th sweep, he's going to have a vehicle, piece of equipment to drive from point A to point B. If I choose to, I could put that on my equipment replacement list as well, build it into today's pricing, and then when we get ready to hire that additional sweep, we've got the money set back for that piece of equipment. That's obviously going to raise my hourly rate a little bit. So it's optional. If you want to put it in there, fine. If you don't want to put it in there, you don't have to. That's up to you. So in terms of our worksheet, number 1, we're going to list each piece of equipment. In our sample company, we had 3 of them. So let's look at the first one. 2016 Chevy van was going to last me 3 years. Cost me $24,000 to replace it 3 years from today. So I take $24,000 divided by 3. That's $8,000 a year I got to build into my budget, build into my pricing. So I've got 3 vehicles. I do that with all 3 of them. Total it down at the bottom, that's $20,000. So what we find out is we had fixed overhead, that's $82,700. We had variable overhead of 18.4. We picked up $46,000 worth of general overhead from the rest of the company. Now we got to add another $20,000 on top of that for equipment replacements. Now we're up to $167,000 we got to cover before we make a dime in this company. Now, let's talk about field labor. As we do that, let's define a couple of terms real quick. When we talk about field labor, we're talking about the employees whose time we can charge directly to the customer. That's the technician out there doing the cleaning, that's the mason out there doing the chimney, that's the relining, whatever it happens to be. It's the individual whose time we can charge directly to the customer as opposed to somebody in the office. When we talk about non-billable time, we're talking about time that we pay field labor for, but we can't charge directly to the customer. That's things like shop time in the morning, shop time in the afternoon, travel time between jobs, sick, vacation, holiday, working on the vehicles. It's any time I pay my field labor people for that I can't charge the customer for. Now, non-billable time is not necessarily non-productive time. We can all have situations where we have a technician come into the office, work on a vehicle, maybe put up some stock, do something around there. It's helpful, it's appreciated, it's productive, but it's non-billable in the sense that we can't charge that directly to the customer. So again, billable time is the time that we physically charge the customer. Non-billable time is time that we pay for that we can't charge the customer for directly. And we'll charge them indirectly here in just a moment. So let's see what typical non-billable time is. Let's assume for a moment we pay for 2 weeks of vacation. That's 80 hours a year, or 3.8% of their total time that's non-billable. Let's further assume that you pay for 9 paid holidays. Now, some of you pay more than that, some of you less. You can adjust it. For 9 holidays a year, that's another 72 hours a year, or 3.5% of their total time that's non-billable. And then let's further assume that we pay for 5 sick days a year. Now, if I'm paying for 5 sick days a year, that's 40 hours a year, or another 1.9% of my total time that's non-billable. So just vacation, holidays, and sick, that's 192 hours a year, or 9.2% of my total time that's non-billable. Now, that's if they came to work every day, if they worked 8 hours a day, and if you could charge that 8 hours to the customer. And that's not going to happen. We can take our ideal technician. This is my model employee, the best I can hope for, who only has 1 hour a day that's non-billable. I mean, that's shop time, travel time, everything else. 1 hour a day is non-billable. That's the best case scenario. 1 hour a day times the 47 working weeks that aren't vacation, holiday, or sick, that's an additional 235 hours a year, or an additional 11.3% of their total time that's non-billable. So just vacations, holidays, sick, and 1 hour a day, we're at 20% non-billable time, best case scenario. Now, think about things like callbacks, warranty work, company meetings, customer no-shows, make work around the office, those weeks where you paid them for 40 hours, even though you only had 35 because you didn't want them to go somewhere else. You add that all together, and you know what, find out? The average service technician, service meaning he's doing sweeping or repairs, traveling, doing 3 or 4 jobs a day, his non-billable time is going to be somewhere between 40 and 55%. Roughly half their time we can't charge out. Now, when it comes to an installation crew or a relining crew or a masonry crew, where they're on a job all day long for the most part, that's entirely different. Their setup time, their travel time, that's all usually part of the bid price of the job. So when it comes to an installation crew, it's pretty much their sick, vacation, holiday, excuse me, and maybe a couple hours a week that you can't charge to the customer. Big difference. The biggest error that happens when most people go through the pricing is we overestimate the number of hours we charge the customer. We think we charge out a lot more hours than we really do. So when you're estimating your hours, I want you to be on the conservative side, underestimate it. Okay? Now, excuse me, this is worksheet number 2. This is the most difficult worksheet we're going to have all day, and it's not hard. But this is where we calculate our cost of non-billable time and our average hourly rate. So we're going to take the technician. First one makes $21.50 an hour. If they're a full-time employee, put 2,080 hours out there. So 2,080 hours times $21.50 an hour, that's $44,720 a year. Now, if you've got seasonal labor, and some of you do, then just fill in how many hours they work each month right here, and then come up with the total hours for the year and the salary. Okay? So if I add all the hours, that comes up to 6,204 hours I'm going to pay for during the year. Add up all their salaries, that's 119,600. So if I take the total dollars divided by the total hours, my average hourly rate is $19.17 per hour. That's a weighted average of my 3 technicians. Now, we said in our company, sample company, we had 45% non-billable time. So if I take 45% of my total hours, 45% of 6,240 hours, that's 2,808. So if I multiply 2,808 non-billable hours times $19.17 an hour, that means my cost of non-billable time is $53,829. That's time I'm paying for that I can't charge a customer for. That's my single highest cost of doing business in the entire company. And that needs to go into my overhead and be part of my hourly rate. And by the way, if I take my total hours here, subtract my non-billable, then this is the number of hours I have left that I can actually charge the customer next year. So if we've got our fixed overhead, we got our variable overhead, we got our general overhead from the rest of the company, we added $20,000 for equipment replacement. Now we got to add another $53,000 plus for non-billable time. Now my cost of operation for my 3-man company, 3-man department, is $220,000 a year. That's huge. And I got to cover all that before we make a dime. Now, let's look at materials. We want to talk about materials. It's anything that you're going to use, from bricks to reliners to chimney caps, anything you're going to sell the customer. We generally sell those wholesale, retail, or some combination of the two. The question being, what part do materials play in my business? That is, do they basically pass through with very little markup, little gross profit, or do we have significant markup, significant gross profit? Now, in your particular industry, we've got some pretty nice profit there. You sell a chimney cap, you're looking at 100% markup or more, and a lot of the other parts and things that you sell as well. So we've got significant markup and significant profit on the sale of our materials. So if you look at worksheet number 3, it has 2 sections, option 1 or option 2. You can use either one. You just do one thing like we're doing today, we'd use option 1. And that is, we have one department. My total cost of materials was $50,000. Remember, we said we're going to mark it up 100%. So that's another $50,000. So my total materials I'm going to sell the customer during the year is $100,000. Now, if you have other departments in your company, then you can look at the equipment that you sell in the installation department, its markup and total. In our sweeping department, its markup and its total, and just have a weighted average down at the bottom. But for our sample company, we're going to use the $100,000 figure. By the way, I realize it's kind of like getting a drink of water out of a fire hydrant. You're getting a lot of information really, really quick. You can review these later on. Each of you hopefully have downloaded the handouts, so you'll have these sheets in front of you. And I'll also send you a copy of the blank ones if you like afterwards for you to walk through again.
Yeah, they were sent out before the webinar, and I think so everybody should have them. If you don't have them, we'll get them to you right after the webinar.
That's a good deal. Okay, let's talk about overhead a little bit. We talked about overhead. We're basically saying, hey, what's the cost to run your company? Okay. And we got 2 types of overhead we're pretty familiar with. We have fixed overhead and variable overhead. We talk about fixed overhead. Those are items that we have to pay no matter what. That's like rent and utilities and insurances. If we double sales, triple sales, or don't sell anything, we still got to pay the fixed overhead, got to pay the rent, even if you don't do a thing. Variable overhead, however, by definition, is directly tied to productivity. Meaning if we do more work, it goes up. If we do less work, it goes down. So variable overhead are things like gasoline in the vehicles, maintenance in the vehicles. These are MasterCard charges, miscellaneous supplies on the job. All those are things that are going to go up if we do more work and go down if we do less work. And in theory, if we didn't do any work, they'd disappear. But the fixed overhead continues. Now, why is it important to know what your overhead costs are? Well, it's not impossible to set an hourly rate because we've all done that. But it's impossible to set an accurate hourly rate until we know what it costs us to do business. We also want to know if we're out there and the customer wants to negotiate on the job a little bit, how much can we negotiate? Well, we can't do that until we know what it costs us to run our company. Now, I want to jump ahead just for a second to kind of get us focused on where we're going and why. Let's say when we're through here, my hourly rate comes out to $49.50 an hour, and maybe this is my masonry department. And that $49.50 is made up of an average wage of 14 bucks an hour, fixed overhead at $24.25, variable of $6.25, and $5 profit. And this $49.50 rate is based on the fact that we said we're going to bill out 6,000 man hours next year. Now the question is this: if that rate's based on billing out 6,000 man hours next year, what happens if we bill out less than 6,000 man hours? If I bill out less than 6,000 man hours, I'm not going to cover my fixed overhead because it's based on billing out that many hours during the year. Now, the other question is, what happens if I bill out more than 6,000 man hours? What happens to that 6,001st man hour? What's not there anymore? That's right. My fixed overhead drops out. Okay. As soon as I've hit my 6,000 man hours, this fixed overhead is covered. I don't have that anymore. So in theory, I could take my $49.50 rate, subtract $24.25 from it, charge $25.25 an hour, and make the same profit it did before, and I'm not going to do that. What that means is as soon as I've hit break even for the year, profitability skyrockets because my fixed overhead's already covered. That's why I said earlier, be conservative on the number of hours you bill out, because as soon as you exceed that, profitability goes way up really, really fast. Now, let's say it's late November and the company's worked 5,500 of their 6,000 man hours. We've got an opportunity to bid on a job. It's got 800 man hours in it, and we can finish it by the end of the year. Can I lower my bid price on that job and still make a really nice profit? Now, if I'd ask you in the class, you'd give me some feedback, but it's kind of hard right now. So yes, I could. Why? Because we got 800 man hours in there. That means I'm going to have 300 hours more than I budgeted for the year. So theoretically, I could take that 300 hours times my $24.25 an hour fixed overhead, subtract that from my bid price, and still make the same profit I did before. Now, I'm not going to drop it that far, but the point is I could if I choose to, because I'm going to exceed my billed hours for the year. Now, that also means during the year, if I'm bidding a job and I'm tracking my hours and I billed out more than I needed to during the year, I've got the flexibility to lower my price if I'll track my billed hours against my budget throughout the year. Now, another cost of doing business is this thing we call company matching taxes. These are the taxes you as a company pay over and above what the employee pays. That includes your FICA and Social Security. All of yourselves as your employees get 7.65% taken out of their salaries. But you being a really nice employer, what do? You match it because you're required to by Uncle Sam. So that costs you another 7.65% of their salary is another cost of doing business. Then you got the federal unemployment tax. It's 0.8%. It's not real large, but you as a company have to pay it. Then the final part of it is your state unemployment down here. That can run from 1 to 15%, depending on how many people you've laid off in the previous year. Now, let's say my FICA tax is 7.65. FUTA is this. Let's say my state unemployment is 4.5%. That means my matching tax rate is 12.95%. What that means to you and I in terms of dollars and cents is that every $100 we pay out in wages, it's costing you an additional $12.95 on top of that for company matching taxes. Now, some of you may be a solely owned proprietorship. Congratulations. Uncle Sam gets you there. You get to pay both sides of that. So it costs you 15.3%. So our fourth worksheet calculates what our matching tax rate is. So for our sample company, everybody has a 7.65% for FICA. Everybody has 0.8% for the FUTA tax. My sample company had a 3% unemployment. So if I add those together, my matching tax rate for my sample company was 11.45%. So what do we know about estimating so far? When we said when we're estimating our field labor, the number of hours we can bill the customer, we want to be conservative. We want to be on the low side, if anything. When it comes to our overhead costs, we want to be as accurate as possible. But if you're going to be off, we want you to be off on the high side. In other words, I would rather you estimate your overhead at $100,000 a year, set your pricing on that, and have your real overhead come in at $80,000 than I would for you to set your pricing based on an $80,000 overhead and then have your real overhead come in at $100,000. So if you're going to be off a little bit on the high side. Okay. Now, I know this is kind of hard to see. Hopefully you've got the worksheets in front of you. You can see it a little bit better. We're going to take all of our costs and put them together. So worksheet number 5 is the first of 2 sheets that we're going to summarize our fixed overhead costs for our sample company just in the sweeping department. We've got our dispatcher for $28,500. We've got our non-billable time. That was our $53,000 we generated on worksheet 2. We got our health insurance, $9,400. We got our general advertising. We got our workman's comp, and we got our health insurance. And if you look at the next worksheet, it continues fixed overhead. By the way, when you're filling these out, there's different topics on there. If you've got those items, fill them in. If you don't, leave them blank. If you've got costs that aren't listed anywhere on here and you want to use the worksheets, just use some of those blank lines and put them in. So we've got our bad debt up here. We've got money in for our credit cards. We've got our 2 loans down here. Now, loans are one of the big differences between cash flow and accounting. Big difference, huge difference. If you've got a $500 a month loan payment, and $100 of its interest and $400 of its principal, does anybody know what shows up in your accounting income statement? The only thing that shows up is $100. But you wrote a check for $500. Where'd it go? Well, the other $400 went off to Never Never Land. Yeah, it's in your assets and your liabilities, but it's not in your P&L statement, and that's what you pay taxes on. So when it comes to setting your hourly rates, when it comes to your loan payments, take the full amount of your loan payment, principal and interest, times 12. And make sure you put that full amount here on the worksheet so it gets covered by your customer. Again, big difference in cash flow and accounting. Next item is our equipment replacement cost. Remember, we had 3 vehicles. We need to put $20,000 a year back. That's on worksheet number 1. And we had $46,000 worth of general overhead from the rest of the company. So my fixed overhead cost for my company is $211,000, $211,955. That's our fixed. Now we got variable overhead costs. The first item up here says chargeable, payroll taxes on my chargeable field labor. The other sheet, we picked up the taxes on my non-billable time. This is picking up the taxes on my billable time. How do I do that? I take my average hourly rate times my billable hours times my matching tax rate, and in my case, that's a little over $7,500 a year. And I've got some miscellaneous tools that we use on the job, $2,000 worth, $14,000 worth of gas and maintenance, $2,400 for uniforms. So I've got another $25,000, almost $26,000 for variable overhead costs. So I take my fixed and my variable, I add them together, my total cost of doing business from a little 3-man department, this is just 3 techs, my total cost of doing business is $237,888. That's huge. That's got to all be covered before our company makes a dime in terms of profit. Now, when it comes to profit, most companies look for an overall net profit of somewhere between 5 and 15%. By the way, profit is not a dirty word. We kind of have been implied that it is by the government and other people, but profit's absolutely critical in your business. When your inventory goes from here to here, something's got to pay for that increase. When receivables goes from here to here, something's got to fund that. When you want to expand your company, something's got to pay for that. Net profit's what does that for you. So it's absolutely critical that you make a profit, a net profit after everything's covered in your company in order to fund the growth portion of your company. So generally you want to shoot overall for somewhere between 5 and 15%. Now, if you checked every publication out there throughout the trades industry, they all tell you the same thing. Average trades company across the nation makes a 3 to 5% net profit. Is that a good number? It's not even close. Why? Because at the end of the year, you go to your accountant, and if he looks on there and says, my goodness, you got a 18% profit. We don't want to pay taxes on all that. So what's he do? He has you prepay some things here, spend some money over here, gets rid of some of that cash, so you come back to 3 to 5% because that's what you want to pay taxes on. But in terms of trying to set profitable hourly rates, when it comes to your masonry and relining department, you should be hitting anywhere from 10 to 18%. Relining is usually very profitable, or should be. Sweeping, usually you're looking for 8 to 12% net profit. When it comes to repairs, usually 15 to 20% net profit is what I suggest companies shoot for. Okay. Now, we got this big lump of overhead, that $200,000+ worth of overhead. There's only 3 things in your company that can absorb that money. Okay. One is the gross profit you made on the sale of your materials. Second is the gross profit you made using subcontractors, and most of us don't use those, but technically you could absorb some. And if it's not absorbed by those 2, the only thing left is direct labor hours. So let's look at worksheet number 8. This is going to absorb our overhead. So the first section says materials. We said back on worksheet number 3 that we were going to sell $100,000 worth of materials, marked up amount, cost us 50 plus 50, so we're going to sell $100,000 worth. My cost, okay, less my material cost, was 50,000 minus 50. I said I wanted to make a 15% profit in my sweeping department, so I want to make 15% net on my sale of materials, and I want to make 15% net on my labor. So 15% of $100,000 is $15,000. So if I take my $100,000, subtract my $50,000 that I paid for it, the $15,000 that I want for profit, I've still got $35,000 left. That extra $35,000 is going to cover some of my overhead costs. Now, technically, subcontractors could absorb some overhead. The reality is most in your industry don't sub out much work, and if you did, usually only mark it up a little bit, so it's not much value to you. But if you did a lot of sub work, it's the price to the customer, less what you paid the sub, less your profit, and if you had anything left, it could absorb some overhead also. So down at the bottom of the page, we've got our total overhead cost of $237,888. We've got $35,000 that can be subtracted from that with the extra profit I made on the sale of my materials. So now I'm down to $202,888. What's going to absorb that? The only thing left in my company is my billable hours. So if I move to worksheet number 9, this is 9 of 10. My average hourly rate for my 3 techs was $19.17. If you go back to the second worksheet, it's item F. My overhead rate I take my remaining overhead from the last worksheet, divide it by my billable hours. That's on worksheet number 2 also. That means my overhead rate was $59.12 an hour. So to get my break-even rate for the company, it's my average hourly rate at $19.17 plus my overhead, $59.12. Add them together, my break-even rate is $78.29 an hour. That's how much I'd need to charge just to break even. No profit, just to break even. Now, before we look at the last worksheet here, I want to talk just a little bit about profit and markup, because they're two misunderstood terms in our industry today. When we talk about markup, we're talking about the amount of money the company chooses to add to the product or the service to come up with the selling price. For example, if I bought a ball for $1 and I sold it for $3, I have a markup, not profit, markup of 300%. Now, in terms of my profit, profit is defined by my retail selling price to the customer, less my cost, being labor, material, and overhead, divided by the selling price. So in my ball example, I sold it for $3. It cost me $1 divided by 3. My gross profit, or my net profit, was 66.6%. My markup was 300%, but my profit was 66.6. Big difference between the two. What happens in our industry a lot more than it should is we'll have a general contractor call us and say, hey, I'll let you do this job over here for cost plus 10%. And we say, great, I'll take that. So I do the job, I add 10% to it, and think I made a 10% profit, and I'm not. Let me show you why. Let's say my cost of my job was $1,000, labor, material, and overhead. If I simply add 10% to it, that's $100. So I charge the contractor $1,100, thinking I was making a 10% profit. When I calculate my profit, $100 divided by the selling price, I didn't get a 10% profit. I got 9.09%, significantly different. So the question is, what do I need to do in order to determine how much I need to sell that for to actually make a 10% profit? I do that by using what we call the reciprocal or the divisor. What I do is take 1 or 100% and I subtract from that my desired profit margin. So if I want a 10% net profit, my divisor is going to be 0.9. If I want a 20% profit, my divisor is going to be 0.8. If I want a 5% profit, my divisor is going to be 0.95. So in my example right here, if I take my $1,000 of cost, labor, material, and overhead, divided by 0.9, that means my selling price should have been $1,111.11. Now, if I take my profit, divided by my selling price, I got a full 10% net profit. Excuse me. Now, went through that whole thing in order to get to our last worksheet here where we build profit in. So remember, we wanted a 15% profit, put it in decimal form, 0.15. So I got 1 minus 0.15, or my divisor is 0.85. Okay? So in order to determine what I need to charge to make a 15% profit, I take my break-even rate from the last worksheet, divided by 0.85. That means I need to charge the customer $92.11 per hour in order to cover all my costs of doing business, plus to generate a 15% profit. You've got the filled out worksheets that you've downloaded already. If you want a free set of blank worksheets that you can work through the process yourself, just give me a call at 1-800-432-7963, or you can email me at tomgrandy@grandyandassociates.com. I'm glad to send you a free set of those as well. Okay? Now, once we know what our hourly rate is, it's pretty simple to bid a job. All we need to know is our hourly rate. We just went through the process for that. What's my estimated build hours on the job? How long is it going to take me to do it? Generally, we bid most jobs in half-day or full-day increments. So it's going to be 4 or 8 hours most of the time when you're doing a big job. Okay? What's the cost of my materials? The cost of my materials includes my materials, my equipment, permits, everything you're going to spend on the job. And then what was my average markup that I used in order to come up with my hourly rate? So to bid a job, my hourly rate needed to be $65.25 an hour. I'm going to have 48 hours in the job. That's 2 guys for 2 days. My total investment of materials, whatnot, is going to be $1,850. My markup I used in order to get that $65.25 an hour was 35%. So to bid that job, it's simply 48 hours times my hourly rate, plus my materials and a 35% markup. Add them together. My bid price is $5,629.50. Bidding becomes really quick, really easy once I know what that hourly rate needs to be. And then as costs change within my company, that rate goes to $70 an hour, same process. I just change it to $70 an hour and use the same bid process. Now, the rate we just came up with is only good if 2 things are true. That is, my actual fixed and variable overhead costs are pretty close to what I estimated, and if the actual number of chargeable hours is pretty close to what I estimated. If either one of those is off, my hourly rate's no longer good. So obviously I've got to track those 2 things throughout the year to make sure I'm in line with them. Now, we've got the ability now to take any overhead cost we've got and relate that back to dollars per hour in terms of our whole hourly rate. So for instance, let's say my equipment replacement cost was $56,000 a year. If I divide that by my billable labor hours, that means my final hourly rate, $9.75 of that was because of equipment replacement cost. I can do that for any overhead cost I've got. Let's say rent was $12,000 a year, $1,000 a month. Divided by my billable labor hours, that makes up $2.09 of my hourly rate. Now I can go through, because of that process, I can go through what I call the what if process. What if I did this? How's that going to affect my hourly rate? Let's say I've added an additional person in the office. That additional person in the office is going to cost me $38,000 a year. Divided by my billable labor hours, if I'm going to hire that individual, I better be ready to raise my hourly rate $6.61 an hour. What if I decide to change locations? And when I do, it's going to up my rent or my mortgage $800 a month. $800 a month times 12 months divided by my billable labor hours. If I'm going to move, I better be ready to raise my rate $1.60 an hour, 67 cents. And the one that gets a lot of people in trouble is this one right here. And this is when the owner moves from the field into the office. If I'm out in the field, I'm productive labor. That's great. I'm getting paid for being out there. But when I make that transition from the field into the office, I just became an overhead cost. So if I'm paying myself $45,000 a year and I move from the field into the office, divide that $45,000 by my billable hours, I better be ready to raise my hourly rate $7.83 an hour. Just as a ballpark for you, most of the time when the owner moves from the field into the office, you usually have 3 to 5 technicians out in the field. That's telling me in most cases you're going to have to raise your rate somewhere between $8 and $12 an hour when you move into the office just to make the same profit you made before. Now ask yourself a question.
Wow. How
many of your friends, neighbors, relatives who moved from their trade from the field into the office, how many of them raised their rates $8 to $12 an hour when they did that? And the answer is pretty close to zip. And what happens? We start that 1 to 4 year process of going out of business, and before it's too late, we're out of business. Now it works the other way too. You find an insurance company that you can pay $5,000 less for insurance during the year, divide it by my billable hours. I'm going to increase my profit 87 cents an hour, or I could lower my hourly rate 87 cents an hour. We've been through the whole process, I know really quickly, but just keep one thing in mind. Knowing your numbers makes a huge difference in how you run your company. If you're not set as a profitable rate right off the bat, the rest of it's fluff. You can be the best marketing company, do the best quality work in the country. You're still going to lose money. Once you know what your numbers are, stick with them. To give you a real life example, several years ago, we have 2 fireplaces in our house. We were going to change them over from wood burning to gas. We went to our local store here. It was probably the most knowledgeable lady I've run into in many, many, many years. She told me all about the different types of gas inserts I could put in there, the pluses and the minuses of each one. She demonstrated them all. She told me everything. Gave me the price for putting the 2 of them in. After she gave me that price, I started negotiating with her. I said, hey, we've got 2. You're only going to make 1 trip out there. Can't you give me a little discount here? No. I tried something else. She said, no. I said, well, can't you give me some kind of discount? No. After about 15 minutes of that, you know what happened? I put my hand across the desk. I shook her hand. I said, congratulations. You did exactly what you should have done. That's your price. That's what you need for profit. Don't negotiate.
Well, I think
so that's kind of the end. I'm going to turn it back over to John for a second.
Yeah, I just want to, you and I talked about this a little bit earlier, but, something, and I can tell you from my experience, once you really understand your cost of doing business, there's something that happens when you communicate to that customer. There's a confidence that gets communicated almost subconsciously. But, when you're talking numbers with them, they try to, the negotiating tactic is always oh my gosh, that's way too high. The flinch, if you want to call it that. And, but when you know your cost of doing business, negotiations become very easy because you're negotiating to go bankrupt. And so, it's very easy. And when you have conviction about your pricing and you know that it's fair, then the customer picks up on that. And I think you get to yes a lot more often. And, that's certainly, you and I, the other thing I wanted to just mention briefly about, just share that story you shared with me a little bit about the sweep in Birmingham, Alabama, when you were there. That was kind of a funny story.
Yeah, we had a chimney sweep in Alabama who came to one of our 3-day boot camps, and they found out they needed to raise their rates rather significantly. So they went home. I called them a couple weeks later and said, did you raise your rates? And she said, yeah. And she kind of chuckled, and I said, what are you chuckling about? And she said, well, I raised them. He said, I didn't get a single complaint from my customers. Said, so I raised them again. I didn't get any complaints. Said, I raised them a 3rd time. Didn't get any complaints. Said, is there no end to this? But obviously there is an end to it. But,
the other thing, I think
they're willing to pay a lot more than you think they are.
Yeah, the other thing too, I think you've got to get your team on board with the pricing. So let's talk about. I know you guys offer a lot of services to contractors, and just so you pull up your kind of tell us what you do, how you do it, how if someone wants to engage you, how might that look?
Sure. First of all, again, if you want a free set of blank worksheets so you can go through the process yourself, the number's on the screen, my email's there, just write it down or give me a call. I'll be glad to send them to you. We always like to have a seminar special, and we have one today for you. The second item John was hinting at a little bit right there is it's called, why do we need to charge so much? The bottom line is, if your employees, especially your technicians, don't believe in the hourly rate you're charging, they'll tend to underbill the customer. So this is a DVD that walks you through the process, kind of like what we did today with the sample company, that goes through and helps the technician understand why you've got to be charging what you're charging. It says, hey, we got this $45,000 truck. Who's going to pay for that? Well, do some quick math. Well, that's $12 an hour we got to put into our rate. And it goes through all the different costs of doing business like that, so they get a sense of what it costs you. The first item on our little list here is our labor pricing software. That's been around for a long time. It models your company by department, tells you what you need to charge in each department, creates month-by-month cash flow budgets for you, lets you actually price a job and see what the pricing is and the break-even price as well. And then it lets you go through the what-if process of changing things. Hey, if I had another tech, change an overhead cost, how does that affect my hourly rate, my profitability? Third item on the list is the company policy manual. That's an absolutely critical item in your business today. That needs to spell out all your hiring, firing practices, drug testing, vacations, everything in there. This is a 96-page company policy manual. It comes in Microsoft Word, so you can change anything you want, push the button, save it, print it out. It's a real quick way to get a very detailed company policy manual, 96 pages. And then we have our program called the Service Manager University. That's a set of 8 CDs, walks you through the process of how to run a very profitable service department. Those 4 items together normally would be a little over $1,000. If you're interested in it, it's only $499.95. Each of you should have received a sheet like that with your presentation that was emailed over to you today. So just check that and send it in if you're interested. We also do a tremendous number of what we call company overviews. I've worked with dozens of sweeps across the country. And that's where I physically come to your location. It takes 2 days. We use the modeling software. We go through and model your company, find out what's making money, what's not making money, find out what we need to be charging per hour in each different department. Then we start going through the what-if process of changing things to find out how to maximize your profitability. The software stays with you afterwards, so when things begin to change in your business, you hire another tech, put them in there, you change an overhead cost, put them in there, push the button. Gee, we got to go up $1.14 to maintain profitability. 2 days, you can get a really, really good feel for where you need to be. So you get a $500, it's normally $4,500 for the 2 days plus travel. You get a $500 discount because you've been through it today. So if you're interested in any of those things, give me a call, send an email, or just fill out this form and fax it back to the office.
And if it makes you money, it doesn't cost you a thing. And I promise you it'll make you money. Any of those services that you just, you know, one of the reasons why I wanted to have Tom on today is because we're going to be talking about scaling your business on July the 9th. And in order to scale your business, I mean, you know, if you had the economics to scale to a broken system, you just have a more broken system. So it's really critical that you get this part fixed before you begin to think about scaling your business. So Tom, I'm just curious, I had one quick question for you, and then I'll turn it over to Chuck. But you, so how often do you recommend looking at this? Is this something, an exercise you would do once a year, once a quarter, anytime you have a change in your business? Obviously, you would want to do that, but you know, some of the overhead costs and things like that are going to be hard to calculate, you know, when you're moving, you know, on a forecast.
That's a really good question, John, and one needs to be addressed. What I tell contractors is I would go through the whole pricing process a minimum of twice a year. But anytime you make a significant change in the company, hire another tech or lose one, spend another $5,000 or $10,000 in overhead for health insurance or something, anytime you're going to make a significant change, put it in there, push the button, or go through the worksheets and recalculate it again, because it's going to substantially change your pricing. If you're going to spend $10,000 more, it's going to affect your pricing.
I don't think a lot of us really understood about how many hours. If you track these things, it's amazing how many non-billable hours you have in your company, and then your replacement costs for everything. It's just something that, you know, you know, it's, you know, it's not something you can Google and get it fixed easily. I mean, these are things. I'm glad you brought all these things up today, Tom. You've been a real help to our industry, just a real blessing to our industry for many years, and so we're thrilled that, you know, you found us or we found you. I don't know how that happened, but a lot of us have been helped because of your gifts and talents, and we really appreciate that. With that, I'll turn it over to Chuck, and I want to thank you again for being here today. If you weren't able to make it, I hope you'll listen to it online or tell your friends or send the link. So thanks a lot.
Well, thank you, Tom. Your words of wisdom are true gold for service industries. I can swear by it. And again, thank you, John, Meredith, Saver Systems, for hosting a great program and panel once again. And the CSIA and the NCSG hopes that these panel discussions and this one today is really something that helps you understand your business and helps you move forward. It's all about being profitable. As an association, we believe that our members and credential holders are in complete alignment with helping our trade by providing these timely topics. And it's going to be the best return on your investment is by dealing with us and taking these panels to heart. Next week, the topic at 4 o'clock Eastern Standard Time, next Thursday, or excuse me, in 2 weeks on Thursday, July 9th, is going to be Scale Your Sweet Spot, what you should know as you grow. A little bit later today, you're going to be emailed a survey. Please complete it and return it as soon as possible. We prepare future content based on what that survey results tell us. I read every single one of them and compile the data, so I'm familiar with what you're looking for. John and I discuss it, as well as Jasper and the other people on our committee. I want you to remember that CSIA and NCSG are the future of this industry. Stand with us, we support you, and we will all rise and prosper together. Stay safe, and thank you.
Thanks all.